whenever the stock market goes through a correction like it just did, that 10% correction, it really gives me a lot of insight into how the world, the investment world, is thinking about their money. I'm talking about from mom and pop to institutional investors, really everyone. What are they doing with their money? How are they thinking? And one of the many great things about price charts is it can tell us very quickly how people are feeling about their investments in the stock market. So what I want to do is I want to kind of take advantage of this most recent 10% correction and look to the charts and have the charts tell us what has changed, if anything, with what people are thinking about their money that's invested in the stock market. Hey everybody, this is RC Peck, and this is my weekend podcast. And my theme for this weekend is bigger is better than big, but safer is better than bigger. So I will explain what this means. Bigger is better than big, but safer is better than bigger. So let's look to the charts to see what this actually means. The first chart we're going to look at is a comparison of two indices. One is the S&P 500, and the other one, which is the blue line, and the other one is the Dow Jones. So we have the red line as the Dow Jones, 30 stocks, 30 of the larger stocks, though not the largest stocks in the US, but 30 of the largest stocks against 500 of the larger stocks. And what you can see is this past year, year to date, the S&P is up about 10.5%, and the Dow Jones is up 6.5%. So it is lagging 4 percentage points. It's lagging about 40% behind the S&P, which tells us that the largest 500 are feeling safer or a better investment than the larger 30. So that is the first part of the theme, where bigger, which is the S&P, is actually outperforming big, which is the Dow 30. The second thing I want to look at is how is the S&P 500 comparing against mid-cap stocks. So on the screen you see a blue line, which is the S&P, compared against mid-cap stocks. And S&P 500 is absolutely killing mid-cap stocks this year. Mid-cap stocks are up just little over 1%, while the S&P, as you already have heard, is up 10.5%. So people are definitely moving away from those mid-cap stocks, which, again, historically mid-cap stocks are smaller, but there's also a feeling of maybe more risk, more volatility. And as this bull market, this 5-year bull market in stocks continues, people are looking more for kind of the safer investment according to size, and that is what the charts are saying right here. I then wanted to see if the S&P looked any different to smaller stocks, and this is something I found interesting. So the S&P, of course, is up 10.5% for the year, but small cap stocks are up 2.35%. So small cap stocks have outperformed mid cap stocks. And the only explanation I have for this is more of a trader platform. Traders like the small cap stocks because they move more and it gives them more things to do. So traders are still alive and kicking, trading the small cap stocks, but still the S&P 500 has absolutely crushed small cap stocks about 400 or 500% better, relatively speaking. So we know the S&P is beating the big stocks, the Dow Jones. We know it's beating the mid cap, and we know it's beating the small cap. So the world, or investors, are basically saying, give me a nice big grouping of stocks that feel safe. And I even compared the S&P against dividend-producing stocks. So these are stocks in the S&P 500 that have a higher dividend. Now, the higher dividend stocks have done much better than anything else we've looked at, but they're still underperforming the S&P, but only by 1 percentage point. So the S&P is up about 10.5% this year, and dividend-producing stocks are up 9.5%. And they pay a slightly higher dividend, per the name. So really, S&P 500 and dividend-producing stocks, they're up about the same, which is really interesting. And if you can see the chart, you can see that the red line has underperformed up until the big 10% correction this year, and then it has accelerated up just as fast as the S&P 500, which probably means that 10% correction scared people into safer stocks. So I've got one more comparison that I thought was the most interesting, and it's comparing the S&P 500 against a set of stocks that are called Aristocrats. Now, to become an aristocrat, you have to have risen or increased, I guess that sounds better. You would have had to increase your dividend every year for a quarter century. So a company that can increase their dividend every year through the 50% correction in 2000 and the 58% correction in 2008 and whatever else has been happening for the last quarter century, these companies, there's about 57 of them, they've been raising that dividend regardless every year for a minimum of 25 years. There are other companies in there that have been raising, increasing their dividends for 50 years, for a half a century, and even more. And so what this tells me is people are still wanting to be exposed to the stock market, but they're starting to lean more towards quote unquote safer investments. And a company that can increase its dividend for at least a quarter of a century is for sure a much safer investment or stock or company to own than the overall S&P 500. So I thought that was really interesting. The takeaway is, yes, the market is going up. Yes, the market is in green light mode. But what is doing best? And the answer is sectors or indices or baskets of stocks that are considered safer. And an aristocrat is definitely considered a safer stock. So the takeaway this weekend is safer is winning. Hey guys, this is just another step to secure your portfolio, your future, and your life. Until next time, this is RC Peck.